Well, fresh data from China has showed consumer inflation at a 5-year low. This comes after yesterday's data showing China's exports also missed the target in 2014. For a closer look at China, let's go to London now to speak to Ashraf Laidi. He's Chief Global Strategist at Citi Index. Ashraf, thank you very much for joining us. Take us through the Chinese numbers. How much of a surprise was the weak inflation number out of China today?
Well, last night we had the CPI numbers, which was really in line, but the PPI numbers, the PPI which has been below zero for the last 2 years, came in, showed a bigger contraction, I believe over 3%. The CPI still is above zero, but it continues to slow. And these numbers come on the back of the import numbers. Now we saw the trade surplus of China rose to a new high of 60 billion. But that was because of two things. That was because of imports plunged, and even exports actually fell for the first time, I believe, in over 10 or 11 months. But imports fell 19%. And this is the 7th decline in the last 10 months. So that is a pretty bad sign here, and it really shows us that China and the U.S. are the only holdouts in the currency war. The main economies to not aggressively or to not ease or aggressively ease or to let their currency go down. But I think the Chinese will have to weaken the Chinese yuan this year further down than it is, which will be quite disinflationary for the rest of the world, which will in turn give little choice to the Fed but to, I don't want to shock anyone, but to stop from raising rates.
So, Ashraf, do you feel that because of the low inflation numbers, obviously they may even cut interest rates, but isn't that going to be driving, already kind of unproductive, debt-ridden growth there, continuing to do that and cause more problems down the road for China?
Yes, well, it may. I mean, this is one of the questions that some people had the question for the Bank of Canada. We have to be careful about cutting rates, not to further provoke debt. But I think in China, yes, it is bigger. It is a bigger problem. I think they want to go down the way of basically pumping liquidity further rather than cutting the target rates. But I think that, look, when you compare the trade numbers for China compared to, let's say, 2008, 2009, and compared to the slowdown of 2000, the numbers are really deteriorating at a much faster rate than at those times earlier. And I think that probably the priority of stimulating domestic growth and also trying to stimulate the external growth, I think that will lead to further weakness of the currency and the market. If you look at the deviation between the reference rate, the Chinese yuan rate that the central bank sets, and the offshore rate or the interbank rate, the interbank rate is weakening faster and faster, and the deviation between both rates at an all-time high. So we think that will give the tendency for China to sort of export disinflation or deflation, if you will, to Europe more. And with the Federal Reserve, probably if they do raise rates, it will be a big policy mistake.
Well, what would be the consequences of that error if the Fed does go ahead and raise rates in 2015?
Well, listen, I mean, some people may say, what is a 25 basis points going to do when the job market is growing gangbusters and the personal consumption expenditure is growing very, very strongly? We think that probably it's very hard to argue with what the bond market is trying to say. And even though bond yields have risen a little bit more, I think that probably the flattening in the yield curve, if we go into a sort of an inversion, and we could be probably 1 to 1.5 months away from seeing the yield curve in the US moving from flattening to inversion if it continues to flatten at the way it is. And I think we could, and if this happens, then we could see what we have learned from the bond market, which is probably 12 months from after the after the yield curve becomes inverted, 12 to 16 months, we could probably see a recession, or in the form of the Fed being forced to go into further easing. And so let's just see how the market holds out right now. So I think that while people are feeling okay from the US, and as we speak right now, the markets are up because there is rumors of an extension, a 6-month extension from the EU for Greece. I think China is going to be the red flag in the next weeks to come.
I'd like to hear your views, Ashraf, lastly, on the commodities market. Are we at the end of the commodities super cycle?
It does look like it. Look, these super cycles, they have lasted 12 to 13 years. This one started around 2002, whether you look at any of the major commodity indices, or if you look at even Chinese demand or Chinese imports. If you overlay that to Chinese imports next to copper, next to the Australian dollar, you will see that we have seen a rise from early 2000 to 2008, and we've come down, and the 180-degree term is seen in most commodity indices. And I think that we are in the last vestiges of that commodity super cycle, and that's why any rally in gold is likely to be an opportunity to sell than an opportunity to buy.
Ashraf, thank you very much. Have a good day.
Thank you.
That's Ashraf Laidi, Chief Global Strategist at Citi Index, and he joined us from London.